What's worse than a strong man at the helm of Turkey? Well, for investors, it seems the even bigger danger is having no one at the helm at all. That's the situation the country might be in after the ruling AKP failed even to win a majority in Parliament, let alone the supermajority that it needed to start the process of handing more power to the president, something a lot of people in Turkey have been very worried about. The lira and stock market tumbled, the currency having its biggest fall against the dollar since the aftermath of Lehman, although it has recovered a bit from the absolute worst. Never mind that the president and his pet theory that high interest rates cause inflation now has no chance of securing the new powers that he wants. The uncertainty about whether there be a coalition, which all opposition parties rejected, or a minority government, or perhaps even a new election, was enough to scare off capital. Now, this is a problem. Turkey needs to attract $4 to $5 billion a month to fund its gaping current account deficit, even after its oil import bill dropped with crude prices. You can see the reasonably close relationship between the current account balance here in red, that's smoothed over 12 months, and the price of oil, which is inverted, so that's when oil's cheap. When oil's cheap, the current account balance, current account deficit here, because this is all negative, is less serious. So it's good when the current account balance goes positive. With Turkey's companies having borrowed heavily in dollars and euros too, makes it even harder to withstand a sharp drop in the lira. Another round of emergency rate hikes to try to protect the currency looks increasingly plausible. In short, Turkey's having a classic emerging market problem. As its economy slows, central banks forced to raise rates to protect the currency, which hurts growth further. It can't act counter-cyclically the way central banks should. But it's worth reflecting on how far emerging markets have come. Now, Turkey's been the real problem for EM investors this year. The country has serious issues that will be hard to resolve. The election result won't make it any easier to take the nasty medicine that the market's prescribing. But contrast what now counts as political instability to the past. From the 1960s through to the 2000s, Turkey had a military coup every decade. Rather than a crippling Kurdish insurgency, as it had in the past, the pro-Kurdish HDP now holds 79 seats in Parliament, and proper peace talks have been underway. Now, there were some nasty attacks during the election, but it does seem to have been broadly fair. And Turkey is the worst of the major countries in emerging markets. It's failed to capitalise from the nascent Eurozone recovery, with exports struggling this year, and it's failed to use the windfall from cheaper oil imports to resolve its current account problems. But other EM countries having trouble on the foreign exchanges are more reliant on commodities, places like Russia, Brazil and Colombia, which have been hurt by the global drop, particularly in the price of oil and iron ore. EM's been on a major journey over the past 15 years. You can see on this chart emerging market dollar bond yields, that's the blue line here in the middle, with US junk bond yields at the top in red and US corporate investment grade yields down at the bottom there in green. Now, after the wave of defaults and devaluations in the late 1990s, emerging bonds traded rather like US junk bonds. You can see they came down very, very similarly, trading along the same sorts of lines. But growing demand for EM then saw yields drop to be almost in line with investment grade companies as the global boom was underway. You can see they came down, not quite joining the green line here before the global crisis of Lehman's collapse and everything sold off. But even then, the emerging market stayed reasonably close to investment grade. But since then, the worsening quality of emerging markets, along with the fall in commodity prices after 2011, has seen a shift back to be more in line with junk bonds again. This was the taper tantrum where there was a particular worry about the problems that a stronger dollar would cause for emerging markets. And the overall yield remains far lower than it was in the early 2000s, you can see here, compared with the double-digit figures things traded at back then. Now, that's thanks to the minimalist yields available on US Treasuries, but it does look far too low to compensate for the risks that investors run by holding emerging market bonds. But in relative terms, emerging markets are perfectly reasonable. The problem is that EM like almost every asset from US shares to London property, looks expensive thanks to super low interest rates.